we combine our global risk parity portfolio with a carry strategy tilt. And we're going to get into why that is. First of all, broad global asset classes are priced to deliver a return in excess of cash. Okay. Capitalism is operating appropriately. And so investors should expect to earn a premium for taking more risk. And it assumes that returns are in proportion to volatility. Volatility is a measure of risk. Returns are proportional risk. And so returns are proportional to volatility. But are there other ways that we might be able to proxy risk? I think one of the ways that you might be able to proxy risk is the yield on a security. For example, a longer duration bond typically in a normal environment has a higher return, higher premium or yield than a lower duration bond. And that's because investors that invest in this longer duration bond have to endure higher price variability because of its longer duration and are more vulnerable to changes in inflation expectation and real rates over time. So, you could say the same thing with equities. Higher yielding equities are reflecting a higher risk of the vulnerability or variability of cash flows, a higher risk that a company may or may not pay dividends, et cetera. And the other thing is that you don't always have an environment that's normal. So this year is a great example. We had, in some cases, major inversions of the yield curve where cash rates were higher than rates that were further out along the curve. And in fact, you had a higher expected return from cash than you did from taking duration risk. So that violates the basic assumptions of risk parity. So what I like about this global carry strategy is it says we've got the same diversity in terms of our universe. We're investing across all these global asset classes that are fundamentally designed to do well in different economic environments. We are accounting for their different levels of ambient risk. So we're making sure to hold them in balance. But if a market is priced to deliver negative excess returns, for example, if the yield curve is inverted or the dividend yield, the implied dividend yield on an equity market falls well below cash rates, or a commodity market goes deep into contango, then we probably don't want to hold that market long. We may even want to hold that market short because we're going to harvest the yield on that market from going short rather than being long. It's diversifying across different frameworks. Risk parity says risk and return is connected by volatility. Global carry says risk and return is connected by yield. And we're still delivering the same principles of diversity and balance, but with different frameworks for the relationships between risk and return. And the great thing about this is that, at least empirically, and I think for strong fundamental reasons, a global carry strategy that invests across global equity markets, global bond markets, global commodities has a very low correlation to a traditional risk parity portfolio. So you get this diversified beta portfolio and another diversified beta portfolio, equally resilient to different types of economic shocks and coming together to deliver a whole portfolio that is substantially better than the sum of its parts.